Okay, this is going to be our practice A for chapter 4, completing the accounting cycle. And we're going to start with number 1. And it says that in the blank space beside each account, enter the name for the financial statement column, whether it's the income statement column or the balance sheet column where the normal balance will be extended. So if we were looking at the worksheet and we were preparing that final two columns where we had the income statement column and the balance sheet column, if these accounts had a normal balance, which column would we put them in? So let's start first with equipment. All right, well, equipment is what kind of an account? It's an asset, right? Where do we find assets? We find assets on the balance sheet. All right, our next one, owner withdrawal. What kind of account is that? It's an equity account that reduces equity, but we're also going to find that in that balance sheet column. No, it doesn't go on the balance sheet. Anybody remember where it goes? It's going to go on our statement of owner's equity, which would then give us the ending balance, which goes into the balance sheet for that capital account. All right, our next one is prepaid rent. Prepaid rent is an asset, and that means it's going to go on our balance sheet. Next, we have the depreciation expense. What kind of account is it? Well, it tells us in there. It's an expense. So where do we find expenses? Both revenue and expenses are found on that income statement. So that's where we're going to find that. All right, the accounts receivable account. What kind of account? Obviously, we remember that it's an asset account. So assets, again, go on the balance sheet. Insurance expense, again, it has that title expense in it. So we know that we're going to find revenue and expenses on the income statement. Next, we have supplies. Supplies is an asset, so we're going to find supplies on the balance sheet. Then we have another expense account. We sell two other expense accounts that went on the income statement. This one will as well. And then last, we have cash, which is an asset, so we're going to put that on the balance sheet. All right, that wraps up number 1. Let's go to number 2. Number 2 is telling us to identify which of the following accounts would be included in a post-closing trial balance. So basically, we had to identify, is it a permanent account or is it a temporary account? If it's temporary, it will not be on the post-closing because we would have closed it and it would have a 0 balance. If it's a permanent account, then we will find it on the post-closing because it's a permanent account. All right, so our first one is accounts receivable. All right, accounts receivable. What kind of account is it? It's an asset, right? So for assets, we did not close them. Assets were a permanent account. So that means we will see it in the post-closing trial balance because we did not close it. Let's look at our next one. It's salaries expense. Salaries expense is on the income statement, and it's an expense account. We did close the temporary accounts, which were revenue, expenses, and withdrawals. So since we closed it, it is not going to be on the post-closing trial balance. Let's look at our next one. Goodwill. We saw this in that chart of accounts. It was under the intangible assets. So it's an asset, which means it's a permanent account. So we will see it on the post-closing trial balance. How about land? Land is also a permanent account, so we will see that on the post-closing trial balance. Income tax expense. Well, we're closing out revenue, expenses, and withdrawals. So if we've closed out expenses, this is in that category. It would have a 0 balance, so we will not see it on the post-closing trial balance because it's a temporary account. Salaries payable, that's a liability account. Do we close out liabilities? No, we just close out revenue, expenses, and withdrawals. So that means that liabilities are permanent and we will see them on our post-closing trial balance. All right, let's look at our next one. We have where it's asking us to categorize it. So in our balance sheet, what category would these go in? And it gives you the choices. It can either go in current assets, long-term investments, plant assets, current liabilities, or long-term liabilities. And I actually need to add on there intangible assets. All right, so let's look at these. So we have land held for future expansion. So we have land, which is an asset. It's going to be held for a long period of time. and it's being held for future expansion. So that's the key word here. And that one's actually going to be a long-term investment. All right, next we have our notes payable due in 5 years. So it's not due this year. So that would mean that if it's over 1 year, it's a long term. So that's going to go under long-term liabilities. All right, next we have accounts receivable. Accounts receivable we hope to collect from our customers within 1 year. So that's going to fall under current assets. Then we have trademarks. Trademark is an intangible asset, so it's going to go under the intangible asset category. Then we have accounts payable, and it is a liability. Typically, our lenders are going to want us to pay within 1 year, so it's going to be a current liability. Store equipment. That is going to be like the equipment we use, like a cash register or something like that. So that's a longer time period. So that's going to go under our plant assets. We have wages payable. I can't imagine that anyone we're paying wages to wants to wait more than a year. So that one's going to be under our current liability also. And then we have cash, which we hope it's always going to be a current asset because it is cash. It's already been converted into cash. All right, so that takes us through our first 3. So if you have any questions on them, just take a moment, go back through. You can rewind and see where you got stuck or see if there's a missing one that you need. Let's go to page 2. All right, so for number 4, it's asking us to identify the current accounts and compute the current ratio. So to compute the current ratio, we need to know what is the formula. So the top part of it is going to be current assets. And we're going to divide that by current liabilities. And that's going to give us our current ratio. All right, so now we have to figure out what amount of current assets do we have and what amount of current liabilities do we have to give us that current ratio. So I'm going to use this little space up here to add in there. So we have current assets. All right, we have accounts receivable of $18,000. Plus we have cash of $7,000. We have office supplies of $2,800. And then we have prepaid insurance of $3,560. If we add those up, let's bring our calculator up. We get $31,360. So that's what we're going to plug in. $31,360. That's also our total up here. All right, and then we have to identify what are the current liabilities. All right, well, current liabilities, we have accounts payable, that is $11,000. Let's see what else we have. This is long-term notes payable, so that's not included. We've accounted for those. We have unearned service revenue. That's a liability, so we're going to add that in of $3,000. And we're going to get a total of $14,000. All right, so we put our $14,000 here. We're going to divide, and we're going to round this out to 2 decimal places. If we take $31,360 divided by 14,000, we get 2.24. So we don't have any rounding because it came out even. So our current ratio is 2.24. Now what that means is they have 224% of assets compared to the amount of liabilities they have. So they can more than pay their current liabilities that are coming due with no problem. Typically a ratio of 1 is the lowest you ever want to see, because if it's below 1, that means that they cannot pay their current liabilities with the amount of current assets that they have. All right, let's look at our next one. So number 5 says these 16 accounts are from the adjusted trial balance columns of a company's worksheet. Select the letter of the financial statement column A, B, C, or D where a normal account balance is extended. So A is the debit side of the income statement, B is the credit side of the income statement, C would be the debit side of the balance sheet or statement of owner's equity column, and D is the credit side of the balance sheet or statement of owner's equity column. So let's go through and identify where each of these would be. All right, interest revenue. It's a revenue account, so we're going to find it on the income statement, and it has a credit balance, so that would be option B. Our next one is machinery. Machinery is an asset. Assets are going to be on the balance sheet on the debit side. Owner withdrawal, that is going to be on the statement of owner's equity, and owner withdrawal has a debit balance, so that's going to be letter C. Depreciation expense, we find expenses on the income statement. So for depreciation expense, expenses have a debit balance, so we're going to find them in column A. The next one is accounts payable. Accounts payable is a liability. Liabilities are found on our balance sheet, and they have a credit balance, so that's going to be in column D. Next, we have service revenue fees. So service fees or service fee revenue. So revenue is going to be on the income statement because revenue minus expenses gives us net income. So on the income statement, and revenue has a credit balance, so that's going to be column B. If we look at owner capital is on the balance sheet. It has a credit balance, so it's going to be column D. Interest expense. Interest expense is on our income statement because revenue and expenses fall on the income statement. Expenses always have a debit balance unless you're fixing an error, which we're not doing yet still. So we're going to find that in column A. Accounts receivable has a debit balance and it goes on the balance sheet. So that's going to be column C. Accumulated depreciation. So this is a contra asset. So that means it has the opposite balance of a normal asset. Normal assets have a debit balance. So this is going to have a credit balance. And we're going to find it on the balance sheet. So it's going to be column D that we're going to list it. Our next one is office supplies. Office supplies are an asset. Assets have a debit balance. And they're on the balance sheet. So they're going to be in column C. Insurance expense, just like the other expenses we had, are going to be on the income statement. Expenses always have a debit balance, so we're looking at column A. Interest receivable is also an asset, just like accounts receivable, and assets have a normal debit balance, and they're going to be found on the balance sheet. So for interest receivable, we're looking at column C. The next one is cash. Cash is an asset going to be found on the balance sheet, and it has a debit balance, so it's going to be column C also. Then we have rent expense. Rent expense goes on the income statement with all the other expenses. Expenses always have a debit balance, so we're going to put it in column A. And our last one is wages payable. Wages payable is a liability. Liabilities typically have a credit balance. So credit balance and a liability is going to be found on the balance sheet. So we're looking at column D. All right, so that takes care of our first 2 pages in exercises 1 through 5. We have a few more exercises to do. We have 6, 7, and 8. I'm going to stop this video and you'll see Chapter 4 Practice A Part 2 coming up to cover 6 through 8.